Hi, and welcome to an early global view on Tuesday, March 15th, 2016. It is currently 7:45 a.m. and we're coming to you a bit later than usual because we wanted to see the very important U.S. retail sales figures. The reason for that was the strength of last month's figures, which hinted at possibly the long-awaited reinvigoration of U.S. conspicuous consumption. However, just as a preview to the discussion of the macro data, forget that. Positive figures from last month, like up 0.2 headline, were revised down to minus 0.4, and we got a disappointing minus 0.1 for this month. Even the ex-auto and gas number strips out the volatile energy portion. Last month was revised from up 0.4 to minus 0.1, and while this month came in at up 0.3, the average retail sales is therefore still pretty lackluster. And that's an important backdrop for this rally in equities because we've been saying right along weak data is being offset by the central bank accommodation. We'll have more for you on that in a moment on the disappointing response to the Bank of Japan announcement this morning as we head into the FOMC on Wednesday afternoon. So we have to ask, what has all this meant to the markets? And as of right now, even though the electronic trading has moved over to June and will be moving over to June as well for our next video because this March contract expires on Thursday at the close, but we maintain it because the short-term chart activity, the intraday activity on the hourly and 30-minute doesn't populate very well in the June contract until you get right near expiration. Well, it is off $11 at 20.08. Now that's kind of important because what you have here is a market that was up against the top end of 2010 to 2020 that we highlighted for quite some time, that it missed on the rally after the U.S. employment report strong figures, was trading right up at 2010 pre-market on the ECB press conference last Thursday before it got knocked down to lower support. And while we have interim levels at 1995 and 1986, we had noted the degree to which those were over-under levels and in fact welcomed the sharp sell-off on Thursday because it took us back down to that key 1975 to 70 area. Now, a couple of things on that just as a perspective on how this market traded. We had said right along, this will go back to things we'll look at on the weekly chart, on the intermediates, that 1975 to 70 was indeed a key area. Market pushed up into and then was kind of nervous in front of the beige book going back to the second, and then finally pushed out above it once it saw that was essentially constructive. And the pullback on that Wednesday morning was 1967, which we set as the tolerance of 75 to 70 support on the current go-round. Now, aside from looking at this, the other reason we expanded this chart out as a last look is that this is the overall upward channel. You can see the serial tops up here even before this last high was in place. In other words, this was off these two highs, so this stall out into 2003 to 2007 was into a topping line. But the market's never been back to the broader gradual lower channel, which often happens when markets jump up and then churn and grind higher. But you'll note we put in the midline of that channel once this line was established, going all the way back into the later part of last month, and the market's sharp weakness below it at this point only took it back to support down around the 1892 to 90 area before it recovered back above 1902, and that set it up for further success. At this point, it only tested the midline of the channel. That was back into the 1932 to 25 area. So you can see how these rallies in bear markets tend to stay good once they can't stay down on sell-offs. And we did, once again, like we did back in February, slip below the midline temporarily going back to Thursday when the market was disappointed ultimately with the ECB, but anticipating further accommodation into this week, at least in the form of forbearance from the Fed. No rate hike at the March meeting, got the bid back, ended up putting in a $50 rally from 1970 to 2020 out of last Thursday into Friday. But at top of $50 rally in a Goldilocks bad news is good news market, time for some circumspection. Even if we need to allow, the lower support is now down into the as nearby as the 1990 area. Anyone who's already trading June contract, just subtract $10 from any of those levels as we head toward expiration. And that pretty much does it for the short-term view of the S&P 500.